between 2010 and 2012, a wide range of private equity funds, including the now fallen fund, Abraaj, to others like Helios, Mediterrania Capital and others, raised about $6.5 billion for investment across the continent. Between 2010 and 2015, 17% of Africa-focused private equity investments were in East Africa, including Ethiopia. West Africa accounted for about a quarter of total deals, and South Africa took in 24% of the total. Now, nearly 60% of private equity deals in East Africa have taken place in Kenya in the 5 years to 2018, with Ethiopia taking only 7%. But with the new government keen on welcoming foreign capital and wide-ranging economic reforms, the country of 100 million is regarded as a key growth market. Secondary exits have been the preferred exit route for East Africa-focused private equity funds. Of the 44 exits between 2007 and 2018, the majority were through sales to strategic investors. 22% were sales to other financial investors, and a roughly similar proportion were through share buybacks. IPOs accounted for barely 7% of the total. Now, the median gross internal rate of return over that decade was 20% against a target of 23%. That's according to industry data. Now, earlier, CGTN's Ramanyang explored the outlook for private equity in East Africa in 2020. He started his conversation by exploring industry perceptions of Ethiopia.
For the East Africa bloc, Ethiopia is one of those markets that offers the most exciting opportunities, and predominantly because of its large population and offering a very ready market, and also the pace of industrialization. They have been sort of among the leaders in the region in industrialization and promoting agro-processing and other value chain industries. So in that regard, we've seen quite the growth of interest in Ethiopia. The other thing that has been interesting about Ethiopia is because of the dynamics of the market sort of not being very attached to the rest of the East Africa community, we've seen the growth of local funds. So we have about three predominantly Ethiopia-focused country private equity firms, Zoskale, Cepheus Capital, and them that are locally led and are investing in the market. And because of that, we anticipate to get a lot more deals from that market going forward, because these are people who are based there. They've raised money to specifically invest there, and they know
understand the local culture.
Yes, they understand the nuances of the market. So for instance, in 2019, we had about 4 deals done out of Ethiopia. 3 of those were in manufacturing. One was in TMT, technology, media, and telecommunication.
The thing about Ethiopia's economy is that, yes, it's large. You've got about 100 million people there, and it has been growing relatively quickly, 6% if you take the World Bank's forecast for this year at face value. But there's still some deep fundamental problems there. So currency, for example, there's been a serious shortage of foreign currency in the country. And yes, PE operates on this 7 to 10 year cycle, but are we at a point where we can legitimately say that private equity firms can look at those macro risks and say, yeah, we're willing to take this risk for the long haul?
That's why it needs a local to do the investments in that country, just because they understand how to navigate around that. And to give credit where it's due, they have tried, at least for us in private equity. We're seeing some considerations to collaborate with private capital from the government side and meet them at some sort of middle point where we can be able to transact and promote the economic development of Ethiopia.
Right. A final question. Exits in this market. I know this has been a long-standing stick issue, especially with PE over the last decade, because the standard model elsewhere is take a company, buy into a company, essentially list it at some point, exit, get your cash. Here the model is usually slightly different. It's either you cash out to a bigger firm or you cash out to another DFI. Has that changed? Might 2020 be the year that starts to change? Because we haven't seen listings coming through on the Nairobi Securities Exchange.
Yeah. And I don't know if listing is going to be the automatic exit route for East African private equity, but I will say...
And it isn't the preferred route either.
Yeah, globally, I think even as the markets develop across the world, we're seeing less of the listings and more strategic buys. So Centum exited Almasi to Coca-Cola, for instance, and some of those provide more opportunities for the business to grow, tap into Coca-Cola's asset in the case of Almasi. And in our instance, and speaking to the exit environment to East Africa, a lot of the deals that were done in the last 10 years were done by funds that were set up or with a vintage year of 2011, which means they're just coming out of Fund 1, and this is when we now start to realize the exits. If we look at 2019, for instance, we had about 2 deals from Mediterrania Capital. They exited Haltons, they exited Hillcrest, and that's a fund whose Fund 1 was around 2011. And so we're likely to see more of those as the funds set up around 7 years ago start to mature and get into their Fund 2 and follow-on funds. And the market is ready. We're getting a lot more interest from strategic buyers. And there's also push for consolidation of certain segments. If you look at the investment Adenia made into Tumaini first, and then they bought out Quickmart, it speaks to
especially on the retail side, because that's one of the more interesting planes in the market.
Precisely. Hillcrest was exited to GEMS, which is a bigger school or education institution.